Greetings, Accounting 202 students. So this video is going to be about bonds payable. If you watched the interest rate bond valuation video, you have some insight. I recommend it. What are we going to do today? Well, that was for corporate finance, and in that class we're not interested in debits and credits, but in this class we are. So my first example is going to be about bonds issued at a discount, which of course, what does that mean? That means that when the bonds were sold, they sold for less than their face value, which is typically $1,000. Are bonds always $1,000? Almost always, and in this class, they're always $1,000. Okay, so what does our example look like? We are going to look at 1,500 bonds being issued. That's 1,500 times $1,000. These bonds are going to pay interest semi-annually, which is typical, every half year. And the bond rate of interest is 5.8%. So that's an annual rate. So what we're going to have to do, because we're paying interest semi-annually, is we're going to have to halve that rate to find the cash flow that occurs every 6 months. We're going to say the term of these bonds is 5 years, which means there's going to be 10 interest payments. Yeah? Okay. And then the market rate of interest, which I referred to in the bond valuation video, that's where Charlton Heston comes down from the mountains with the 11 commandments. And he tells you, well, the market rate is 6%. Well, it doesn't work like that. But that's how we're going to do it in this textbook version. In any event, okay, so what do we have to do? First of all, there's going to be 10 payments. There's going to be 2 cash flows. There's going to be the return of the face amount, sometimes referred to as the par value in the book. Return of the face amount, that's a one-time event. That's going to occur when? 5 years from now. And then there's going to be 10 interest payments at 2.9% apiece, yeah? On the 1,500 bonds. That's an annuity, yeah? Okay. So what do we have down here? What in the world is this down here? Well, I have formulas installed here which will calculate both the present value factor for a single sum, which will be appropriate for discounting the return of principal, and also the present value factor for an ordinary annuity, which will be appropriate for the semi-annual interest payments. So now I just got to put over here in this field, right here in cells E15 and 16, and this is going to automatically calculate those present value factors. So let's see, what do we need? For the market rate, for the effective rate, for the yield, we need this number right here divided by 2, yeah? So I'm going to go with 0.03, 3%, and N, that's the number of periods, as previously mentioned, is going to be 10. There you go. So there is the present value factor for a single sum. N equals 10, I equals 3. And this is the annuity factor. There's formulas in there, and you can hijack these for other calculations. Okay, so what's this number going to be? What's the face amount of the bonds? That's going to be 1,500 times 1,000, which is 1.5 million. Now, what's 1.5 million? 10 periods from now at 3%, 1.5 million is 1,116,000 and change. Yeah? Okay, what is the semi-annual interest payment? We got to take this over here and divide by 2, yeah? Which we know is 2.9. There it is. Multiply. 1.5 million times 2.9, $43,500 would be paid out every half year to the bondholders. Okay, and what is that? What are the $43,500 payments worth today in present value? $371,000. And we add these two together, and we get the present value of the whole package, $1,487,205. So these bonds are going out at a discount. And of course, why did that happen? Anytime the bond interest payment is less than the market or effective rate, the bonds will go out at a discount. The investors will pay less for the bonds to increase their yield. Okay, so that's what we have right here, and that's how much cash we'd be collecting. Now, as I mentioned in the other video, what really happens is you sell the bonds, you get X amount of dollars, and then you back into the interest rate. And doesn't come out to a nice even number like that. It'll come out to like 3.17246. Okay. All right, so now we got this number. Let's go with this. What is the original carrying value of the bonds? The original carrying value of the bonds is always what you sold them for. So there's our 1487. We'll drop that over here. What is the unamortized discount? Well, the discount is going to be the difference between the face amount of the bonds and what we sold them for, which is 1487. There's our discount, 12,795. We are going to amortize that discount over the next 5 years. Yeah? What does it mean to amortize? We are going to make this balance go away. So we are going for 0 down here. We want to make this disappear. We're going to increase our interest expense as a result of this discount. And what is this number? This red number down here, that's our target for the face amount minus the unamortized discount. So if you have a $1.5 million face and you have a 0 discount, you should hit this number, 1.5 million. So let's fill in the chart now. This handy chart works beautifully. So what is this first column here? It says this is going to be the bond rate times the face amount. So I want to take, basically I want to take this number here, 43.5. The bond rate times the face amount. That's the semi-annual interest payout. Now I'm going to want to copy this down the page, so I'm going to put a little $sign here. So this way it'll freeze on row 21, yeah? Because if I copy this down the page without that little $sign, it's going to advance to 22, 23, 24. I don't want that. I want to stick right on this number here. Okay. Interest expense. Take the carrying value and multiply it times the market rate. Well, the carrying value is going to gradually go up to 1.5 million. So we're going to get a different number for interest expense every 6 months. So I'm going to take this 1487 over here and multiply times the interest rate, which is going to be the market or effective rate, yeah? 3%, 44,616. Now I want to copy this down the page also, but I want to freeze it on row 15, which is where my interest rate is. So I'm going to put a little $sign over here. How's that look? All right. Amortization of discount, and we're going to look at amortization premium in a few minutes. What do? You find the difference between these two numbers, and I want it to be a positive number, so I'm going to take the interest expense and subtract the cash number, 1116. Now this is the number I want to go away over time. Okay, so let me get rid of these pennies. There we go. So I'm going to take the 12,795 and subtract 1116. I get 11,679. What happens to the carrying value? Well, if the carrying value is the face amount minus the unamortized discount, and the unamortized discount just decreased, your carrying value is going up. So a simple formula would be, let me just take this 1487 and add the 1116, and I get 1488, 321, which is the same thing as what? 1.5 million minus 11,769. Okay. Now, I'm hoping at this point that if I copy these formulas down the page, that this number here, which is period 10, will be 1.5 million, and this will be 0. If that is not true, what does that mean? That means I blew it, I choked, I dropped the ball. All right, let me copy this down the page. See what happens. Holy Toledo. It's amazing, right? All right, so it works. There's the math. This must be a good number, and the formulas look good. All right. Now, in accounting 102, you probably did everything that I have here so far. So here's our entry for the issuance of the bonds. What happened? We sold the bonds, yeah? We debit our favorite account, which is cash, and we credit bonds payable at the face amount. So whenever you are issuing bonds, it's always going to be a nice even number, a multiple of $1,000. If it's a different number, then you know there's something wrong, right? And if you retire bonds, if you pay some of them off, it's going to be a debit to bonds payable for a nice even number. All right, so here's our bond discount, and that I have over here in this little T account. So I keep track of what happens to this balance over time. All right, so our bonds are issued. This 12,795 we want to disappear over 5 years. We're going to amortize it, and let's go to the first semi-annual interest payment. All right, so what is the interest expense? Well, that's what this chart is all about, right? The interest expense is the carrying value times the market or effective rate. So I'm just going to pull this number down here, 44,616. What is the credit to bond discount? It's the number we have over here in this column, 1116. And what is the cash number? The cash is going to be 43.5. All right, so there's our first semi-annual interest payment. Now I like to be realistic as possible, you know, based on my actual experience. This is not realistic. Why not? Well, think about it. How much interest expense did we have in February, March, April, May, June, and July? According to these entries, we had 0. And then all of a sudden, in August, we get whacked with $45,000 worth of interest, yeah? That's not how it works, because you want monthly financial statements. Certainly a larger company, and this would be a larger company because you're issuing bonds, will want monthly financial statements. So what you would do is you would accrue interest every month. Which brings us to our next entry, which is an accrual of interest. We're going to assume a December 31 year end. Okay, so how many months have gone by since the issuance of the bonds? Well, that would be 5 months, yeah? August, September, October, November, December, 5 months. So we want to get the interest expense on the books in 2021 relative to that 5-month period. So that would be the second interval up here. Yeah. So I'm going to use these numbers here, but I don't want the entire number. I only want 5 months worth. So I'm going to take those numbers up there and multiply times 5/6, and that's going to be my interest accrual. So let me take this 44,650 and multiply times 5 divided by 6. And I get 37,208. Okay, now let's try the bond discount, which is 1150 times 5 divided by 6, $958. And let's take the 43.5. I don't really have to do this, but I will, times 5 divided by 6. 36,250. Now there's pennies involved, which I've excluded from these entries. But fortunately, it looks like our debits do equal our credits. Sometimes it's $1 off if you chop the pennies off. In any event, there we have it. Right? There's our entry. That's 5 months worth of interest. All right. Now we go slip sliding into the next year, 2022. And we're going to make our second semi-annual interest payment. Well, one thing we know for sure is the cash is not going to change. Cash is going to be $43,500 every single time. Okay. Interest payable. Well, after we make this payment, the interest payable should be 0. So I'm going to pull this number down here, debit interest payable. Interest expense. This was 5 months worth of interest, so I'm going to drop in the last month over here, which would be 1 month of interest, which would be the month of January. Yeah. So let me go up there again. Is my expense number, and I'm going to divide by 6 for 1 month. Okay, and what happens? Well, we have have to also amortize 1 month's worth of bond discount. So let me take the bond discount number of 1150 and divide by 6. I get 192. Okay, now I'm hoping the debits equal the credits, and it certainly appears to be the case. Yeah. Okay, and we move on to the next semi-annual interest payment. Okay. So now we're up to August 2022. What do we do? All right. Now I'm going to take from the third interval the numbers. What numbers? These numbers, yeah. 44,684 is the expense. The bond discount is 1184, and the cash is the cash. Yeah, it's always 43.5. So what happened so far? We have a year and a half has gone by. 3 payments have been made. So, to make this example real fun, we're going to retire some of the bonds. We're going to retire 600 bonds. So let's say the issuing corporation either went out on the open market, bought 600 bonds, or they had bonds which were callable, and they're going to bring them back. They're going to retire them at $1,058 a piece. Okay, so that's 1 month's worth of interest, 1 year's worth of interest on top of the face value. All right, so that's 600 bonds are going to be retired. So that would be 600 times 1,000. Nice even multiple, yeah. The bond discount is the tricky part, okay? If we are retiring 600 bonds, and there's 1,500 bonds altogether, whoops, that comes out to what? 40%. We are retiring 40% of the bonds. So if we're going to make 40% of the bonds disappear, we want 40% of the bond discount to also go with it. All right, so what is the bond discount on August 1st, 22, after you've made that third interest payment? So we're over here. Bond discount, according to this, is $93.45 after the third payment, which is the balance in this little T account here. Yeah, bond discount, $93.45. We want to retire 40% of the bonds. We want 40% of this number to disappear. It's a debit balance, so obviously we need a credit to reduce it. So let's do that. Let me take this over here. I can take it here or off the chart, doesn't matter. Times 0.4, and we get a number, 37.38. Okay. Now, what is the carrying value of the bonds on August 1, 22? And I don't mean all the bonds, just these bonds. It's 600,000 minus the bond discount, yeah? So the carrying value is 596,000 and change. Now we're going to pay a lot more than that to get rid of these bonds. So we're going to take a fairly large haircut on this. It's going to be a loss, okay? Anytime you issue bonds at a discount, the carrying value is never equal to the face amount of the bonds, yeah? Only on the last day is the carrying value of the bonds equal to the face amount. So if you retire these bonds over here anytime during this 5-year stretch, and you pay more than $1.5 million to make them go away, you're going to take a loss every single time. So that would be typical. All right. So what do we got? There's 2 ways of looking at this. This entry. The cash, we just multiply. We say, okay, 600 bonds, and we got to pay $1,058 a piece. 634,800. So if you compare the carrying value of the bonds, which is these 2 numbers, netted out, to the cash paid to retire them, you have a loss of $38,538. That's one way of doing it. Then there's the old debit's got to equal the credits routine, which gets you the same number, 38,538. So there you have it. So what do we do different from Accounting 102, at least the way I do it and Professor Weinstein does it? Well, we have these interest accrual here, and we have a retirement, but not of all the bonds, which would have been simpler, but 600 or a partial amount of the bonds. So that is using the effective interest method as advertised over here, okay? And the other method is the straight line method, which is not preferred by our friends at the FASB, and I use the term friend loosely. So how do you do this if you are using the straight line method of bond amortization? All right, so we have the cash. Is that going to change because we changed our accounting technique a little? No, of course, it's going to be the same number no matter what, 43.5 every 6 months. Then you say to yourself, self, how often am I going to make this entry? Well, in real life, you're going to make the entry 12 times a year or 60 times. But in our case, we'll say, okay, we're going to make this entry 10 times. And we want what balance to disappear over time? We want the discount to go away over time. This number here, 12,795. So I'm going to take the 12,795 from up here, and I'm going to divide by 10, which gives me 1279.53. I'm going to leave the pennies in there because there might be some rounding issues. So what's the expense? Well, we go back to that debit's got to equal the credits, right? So we add these two numbers together. Bingo, 44,779. Why is this called the straight line method? Because you can do the same thing every 6 months. All right. Now in this case here for the accrual, we only want 5 months worth. So I'm going to just take this entry here and multiply times 5 divided by 6. And I get my expense over there. Copy this formula over here. And that should work, yeah? 36,250 being the interest payable. So you can't credit cash over here, right? Because you're not paying the cash out until February. We move on to February. We make the interest payable disappear. We need 1 month worth of interest. So I'm going to take this, which is 6 months worth of interest, expense, and divide. Yeah. Copy this formula over here. So this part of the entry is 1/6 of these numbers here. Yeah. Which is wrong because we've got to use the cash number. Okay. Now, let's add these two together. 43,713 and 43,713. So we're good to go. Yeah. There's our interest accrual. We go to August 22. What do? We do this again. Yeah. I'm just going to copy everything down here. That didn't work. Let's try this. Okay. And that brings us to the retirement entry. Yeah. This is the balance in our account according to my little T account. These things filled in as we were going along. And supposedly the balance in the bond discount account is $89.56.71. Yeah. Okay. So 1.5 years have gone by. Yeah. So that would be what? 3 out of 10 payments have been made. So if we're using the straight line method, we can check this number here. We say, well, if this is the beginning balance and 3 years have gone by, that means 30% of, not 3 years, but 3 payments have gone by. 30% of that balance has been amortized. So if I take this and multiply times 0.7, which should be the remaining balance, I get the same number, which which if you're an accounting person and you get the same number two different ways, that makes you what? Happy as hell. Okay. Let's get rid of the bonds. 600,000. Let's make part of the discount go away. Yeah. So once again, it's 600 out of what? Out of 1,500, which we know is 40%. I get 35.8269. Okay. The cash is going to be the same because we're using the same numbers. 600 times 1058. The debits don't equal the credits. All right. Here's our carrying value type calculation. The carrying value of these bonds is those two numbers here, netted. 596. We pay 634. We take a $38,000 haircut. Yeah. For those of you who are not familiar with yuppie slang, a haircut is a loss on a transaction. 38,382.69. Zip zip. There you go. Bonds issued at a discount, amortization, effective interest method, which is the preferred, and the straight line method, and a couple of retirements. I know what you're thinking. And to tell you the truth, in all the excitement here, I've kind of lost track myself. That's what Dirty Harry said, right? So let's go to a bond premium scenario. Different set of numbers. Different set of numbers. So what does that mean, bond premium? Well, that means you sold the bonds for more than $1,000. So your bond interest payout cash is higher than the expectations of the investors, which would be the market effective or yield. Yeah. So let me do another one of these present value calculations here. This time I got 2,500 bonds. So the face amount is going to be $2.5 million. The bond rate of interest is what? Is going to be half of whatever's given up here, which would be the 4.4% divided by 2, which is going to be 2.2%. Then when you multiply, what does that mean? Well, every half year, $55,000 is going to be paid out. All right. What about the present value factors? Well, these are formulas in here that are going to calculate that for us. We don't have to look at a chart. Well, what do we want? We want half the market rate, 2%. And again, it's a term of 5 years, so I'm going to go with 10 again. And hopefully, these are the right factors, and that is what the bonds sell for, which is $44,913, more than the face amount of the bonds. All right, so let's go over here and start our chart. The carrying value at the get-go is always equal to what? What you sold the bonds for. This is going to be a premium, so I want to take that 2544 and subtract the face amount, and I get my unamortized premium. I want that to go to 0, and I want this number, the carrying value, eventually to be $2.5 million. So I want the carrying value to go down, and I want this premium to go down as well. All right, let's fill in the chart. Let's do the same thing we did last time. The cash is this number here, 55,000. I'm going to freeze that again. A little dollar sign there. Interest expense is carrying value times market rate. So let's take this 2544 times the market rate, which is 2%. And I got to freeze the interest rate again, right? With a dollar sign in front of the 15. Find the difference between these two numbers. I want it to be positive numbers, so this time I'll do it the other way. Put the cash first. I get 4102. This number I want to reduce by my amortization number every 6 months. I'll subtract 40,000. Which way is this number going? It's going down, right? So every 6 months it goes down by the amount of amortization. amortization, 4102. Okay. Now, does this work? We'll find out in a second, right? We'll take all of these formulas, use my favorite icon, which is the copy icon, and spread it out down here and see what happens. Holy Toledo! Is this the most amazing thing you've ever seen in your life or what? I know, you don't have to say. And besides, I can't hear you anyway. Okay, the issuance of the bonds. Let's do that. So how much cash do we collect? $25.44. What's the bond premium? $44,913. What's going to be the credit to bond payable? The nice even multiple of $1,000. Yeah, otherwise known as the face amount of the bonds. There's our entry. Over time, we want this to become zero. This is a good thing because this is going to reduce the interest expense to the corporation over time. All right, so let's do the first semi-annual interest. Let me see if I can do a little something here. I shouldn't experiment while I'm doing these things, but I'll try it. Freeze the top row. Let's see if I did this correctly. Probably not. Okay, here we go. Interest expense. I'm going to take the numbers right off of what? The chart. So there's my interest expense. I want to debit to bond premium. I want this balance to go away. I need a debit. I'll take the 4102. Okay. And the cash is the cash. 55,000. We don't have any rounding problems because there's definitely some pennies in here, but it works out. Okay. What do we do next? The next thing we do is what we did on the other chart, which is we need 5 months worth of that second 6-month interval. Okay, let's try this. The expense times 5 divided by 6. The premium times 5 divided by 6. And the interest payable is going to be the 55,000 times 5 divided by 6. There we have it. Okay. That's 5 months worth of interest. We go to the 1st of February in the following year. Again, we're assuming a calendar year corporation. 45,833, yeah? Okay, make that go away. Pick up the other month of interest. So divide this by 6. Okay? And then get the other month of amortization. And now we're hoping against hope that the cash credit is equal. And it does not look like it works. And why doesn't it work? It's off by $1 because there's pennies in here. All right, let's not try to lose any sleep on this. All right, you want to make it work. There you go. Okay, now our debits equal our credits. Okay, next on the hit parade, the third interest payment, we go to the third interval. It's over here. We pick up the expense. We pick up the premium. And we pick up the cash. And it looks like we don't have any rounding problems here, so we're good to go. All right. Here's our next entry. We're going to retire 600 bonds again. We're going to pay $1,044 this time. What's the balance in bond premium according to this? Well, we had this debit here. We had this debit for 5 months worth. We had this debit for 1 month. And then we had this debit over here for 6 months. Supposedly the balance is 32,290. And of course that should be equal to what? Should be equal to that number, 32,360. Why is it not equal to that? Good question. Spät. this whole video over again. So here we go. This should be 4184 times 5 over 6. That's better, okay? Should be, the balance should be $32,360. This number must have multiplied times the wrong row earlier. Anyway, here we go. Now we're ready to go. So here's the balance. See what I said before. We always like it when the numbers are calculated the same way twice. Here we go. 600 bonds. All right, make them go away. Bonds payable, that's going to be what? $600,000. What is the bond premium? All right, so we do our little thing over here again. If we made 600 bonds disappear out of 2,500, then what? Then that means 24% of our bonds are going to go away. Okay. All right. What's the cash? The cash is whatever it says, 600 times 1044, 626,400. What's the bond premium? Well, 24% of the bonds are disappearing. I want 24% of this balance to go away. So I'm going to take this, multiply times 24%. 7766 would be 24% of that balance. Okay. Now, we did issue the bonds at a premium, but it wasn't enough to create a carrying value, which was going to give us a gain, which would be, I would assume, very unlikely in the real world. So here's our carrying value, 600,000 plus the unamortized premium, these two numbers. We paid $626 to get rid of these bonds. We take an $18,000 haircut on the deal, yeah? And again, you could do it the old debits got to equal the credits, 18,634, which is that number. There you go. Okay, so that's bonds issued at a premium using the effective interest method, and the last thing we do is going to be the straight line method. So let's try this. It's going to be 10 payments, right? So again, we're going to take the beginning balance. We steal that balance over here, 44,913, and divide by 10. That's going to be our amortization premium. Is the cash going to change? No, the cash is basically set in stone, 55,000. How do you get the interest expense? This time you really do use the old debits, got to equal the credits routine. So you plug a debit in there that makes it work. Then what? Then we need 5/6 of that number, 42,000. Looks like that might work. Okay. Then what do? February 1, we make the interest payable go away. We need 1/6 of the semi-annual amortization. So I'll take this and divide by 6. Okay. Whoops, that's the wrong number. That's for the expense, right? There we go. Okay, 8418, 1/6 of the premium. Debit's got to equal the credits. I'm hoping it comes out to the cash number. It looks like it's gonna work. It does. 55,000. Okay. All right. So that's good. The next semi-annual interest payment, it's going to be another one of these, right? I'll just copy these numbers. It's probably not going to work because I have formulas in there. Yeah, that's exactly what happened. Let's do this instead. Okay. 3 payments, and there was an accrual in the middle there somewhere. And let's look at our account balance. We started at 44,913, which we did with the effective interest method as well. These are the amortization numbers. Okay, here's my balance. Okay, let's check that number now. If 3 payments have been made, 30% of the time has gone by. Okay, we should be able to get the same number by taking 70% of the 44,000. Let's see if that works. $31,439. Once again, what happens when you do something 2 different ways and get the same number? You're happy as hell. Okay, where do we go from here? Let's retire the bonds. This shouldn't be too difficult. This is going to be $600,000, right? Bonds payable always going to be a nice even multiple of $1,000, whether you are issuing them or you are retiring them or paying them off. The cash is whatever the problem says, right? 600 times 1044. $624,000. What's the carrying? What is the carrying value of the bonds? Okay, the carrying value of the bonds is the sum of the bond premium. We want what? What percent of that number do we want? 24%? That's because we had 600 bonds out of 2,500 retired. So you got 75, 35, 45 rather. Okay, there's our debits and credits. Here's the carrying value, these 2 numbers, which add up to 607, but you paid 626 to make the bonds go away. And what does that mean? It means you're not happy. Why are you not happy? Because you took another haircut. Okay, and how much is the haircut? Debits got to equal the credits. Should be the same number. 18,854.63. All right, so there you have it. Premium, discount. What's more common? Discount is much more common. Partial retirement of bonds, and that should be a pretty good foundation in order to do the problems which will be assigned, which you will receive in another exciting update/email. Anyway, signing off for now, much more to come.